7 for 07, CNBC Today.
Shares of Citigroup have been under pressure this week, and of course, it's a day after the banking giant named a new COO. Many investors are hoping for broader shakeups, like the ouster of its CFO or a restructuring of the entire company, and they continue to express concern over Citi's sluggish revenue growth and high expenses. What is the best way to fix Citi? Some thoughts now from Ralph Cole with Ferguson Wellman Capital, which holds over $500,000 in Citi stock. He says he's willing to give CEO Chuck Prince the benefit of the doubt, at least for now. On the other hand, Bill Smith, president and CEO of Sam Advisors, which owns 50,000 shares of Citi, thinks the only logical solution to unlock shareholder value is to dismember the entire company. Thank you, gentlemen, for joining us very much.
Thanks for having me, sir.
Ralph, let me start.
Thanks for having me.
Let me start with you, Ralph. What would you like to hear from Chuck Prince tomorrow about what he plans to do with the company?
Well, I have to say I would have liked to have heard that they were going to hire somebody from the outside to take that president role. And so now investors are really nervous about what they really can say tomorrow to make people feel better about this company. Really, I think people are tired of listening to his stories, and they want to see a little more action, a little more bottom line. So tomorrow's going to be, I think, a non-event, unfortunately.
All right. Bill, what about you? You think, as I understand it, that they should basically break this company up. Why?
I think we went out in January and published some research saying that the only way Citigroup is going to be able to create shareholder value is, in fact, to break up the company. And we think it needs to be done as soon as possible. Adding another layer of management to an already bloated bureaucracy isn't going to get this done.
Mm-hmm. What would what would that do to the stock price, do you think, Bill?
In our opinion, the stock will immediately trade into the mid-60s, and a sum of the parts basis in 3 years, meaning breaking off the investment bank, the international bank, and the domestic bank, could create a total valuation of $80 to $90 a year in 3 to 4 years.
Ralph, what about that? I mean, you sound disappointed by the moves that they've made so far, and I know you've said that you're willing to give, Chuck Prince a little bit more time, but given the decisions yesterday, would you favor more aggressive action like a breakup?
Well, I think a breakup sounds a little over the top at this point for such a large company. I think there really are some synergies here. That's why people are so frustrated by this company. They see all the assets that they have. They should be able to work better together, and they're just not happening. So you can feel it on the street. People want more out of it, and I think that's, costs are the big thing. And, you bring in a COO from inside the company. Mm-hmm. Why didn't you have one the last year and a half? So we'd like to see more aggressiveness, but I think a breakup's a little much at this time.
Bill, Prince Al-Walid suggests some draconian cost-cutting measures, but I guess the question is, can you cut your way to the type of stock performance and profitability and overall performance that Citi really needs? So
you bring up a great point, and he called for draconian cost-cutting measures. That was 6 months ago. Mm-hmm. It took them 6 months to put someone into place to start to address this. Now, this is after Sally Krawcheck said that they were going to attack costs both from the luncheon viewpoint as well as color copies. And it took them 6 months to address this, and now he still doesn't have to have a report back until the first quarter of 2007. So we're talking potentially 9 months before they address the cost cuts, and I think it's too much. And your other guest brings up a great point. He's saying, oh, this is so huge and the company is too big. That's exactly the problem. You have, 125 or 130 billion dollars in revenue. You've got a market cap of 255 billion dollars. This could be broken up into three pieces, each on their own between 120 and 80 billion dollars, mm-hmm. and give each of these managers a currency to work with to take risk and to create shareholder value. I think everyone would be a lot more pleased.
Well, it's going to be an interesting meeting, to say the least. Thank you both, Ralph and Bill, for joining us today, and we hope you'll come back and give us your impressions after tomorrow.
You bet.